Good afternoon and welcome on this Tax Day Eve, Tuesday, July 14th, 2020. I want to sincerely thank all of you for your interest and participation in this discussion as we focus for about the next hour or so on the key stimulus and relief programs rolled out by our federal government and related agencies in response to some of the economic hardships and disruptions brought on by COVID-19. My name is Richey, and I'll be moderating this webinar today. It's a pleasure to welcome you as participants and most likely a lot of CPE seekers as well. We hope to offer you some insights that make your time spent with us so well worth it, as we know and appreciate how valuable your time is. It's also my pleasure and a real treat to be joined by three of Richey May's mortgage banking practice leaders today. First, David Rice, partner in BAS, Business Advisory Services. David's been one of the primary champions of following all things relief and making sure those communications are making their way out to our client base and industry partners as well. Jennifer Hanna, longtime partner of the mortgage banking audit practice. And Jared Frost, partner in charge of the mortgage banking tax practice. Before we begin, just a quick note on the session and its qualifications for CPE. Be sure to enter responses to all the poll questions that you'll see launched throughout the presentation. The response to these questions is our mechanism for verifying attendance and attention. The recording and the slide deck will be distributed to you in the next couple of days. And CPE certificates, those take a little bit longer, so bear with us and we'll email those out to all the participants as well in the coming weeks. We'll likely post all of the materials you'll see today on our website as well, and you'll see them alongside of that many more resources, and we encourage you to seek those out. There's several links throughout this presentation in the slide deck that'll take you to those sources. And we encourage you to seek those out, pass them along to your friends and colleagues. We'd sure appreciate it. Lastly, feel free to use the chat box and send in questions real time to our panelists, and we'll do our best to address them during the presentation if we can. If we don't get to your question, we'll certainly follow up with another piece of material and send that out to the entire group with any questions submitted along with the answers. Right, with that, let's get right into it. I wanted to start, before I turn it over to the panelists, with a quick look back in timeline form at all of the kind of major measures that came out of Washington in response to COVID and the economic hardships. I won't go through all of these, but the way this is displayed, it'll kind of help us frame up how much effort was put in by our federal government to help out small businesses and the economy at large throughout this process. Some of the major items that will be expanding upon today, first would be the emergency disaster declaration that basically created a declared state of disaster nationwide. That was all the way back on March 13th. One of the first bills that really started to offer some monetary benefit to taxpayers, employers mainly, but also the families that depended on maybe an employee of those employers, was the Family First Coronavirus Response Act. Jared, I think, will get into some of the tax provisions that were included in that bill. The major, this should be no news to anyone, I don't think, but the major piece of legislation that really is at the foundation and presides over many of the items we'll cover today is the CARES Act. Everything that's listed there, among a lot of others. We couldn't even begin to spend any time on the vast majority of what's in that bill, but we'll focus on some of these things that we know are most likely to apply to your business. Continuing on down the timeline, and with specific reference to those things that are of most recent update, there's the Paycheck Protection Program Flexibility Act. So as I said, the foundation of the relief provisions, a lot of it ties back to that CARES Act. This was a clarifying legislation, piece of legislation that kind of cleared up some of the gray areas that existed, or some of the areas that needed technical correction in the CARES Act. We'll quickly touch on the FHA waiving QC requirements and what that might mean for your business, and as well as some of the recent things to come out of Washington and the SBA alike to make further adjustments to the PPP program, which again was kind of the foundation and most widely applicable relief program, especially offered to small businesses back in the CARES Act. This timeline, there's many other items in here that might be of use to you, and it's I think it's quite interesting to see in this format. This will obviously be included in the deck, and we encourage you to kind of go back through and look at all the other items and effort that have been put forward in review. So let's jump in right away. I'm going to turn the floor here over to David to kind of start with. David, if you wouldn't mind, maybe start to cover what might be of most recent updating, or what things have been on your radar in the past week to a month, and then kind of work your way backwards on that time frame.
Sure. Thanks, Kalen. So on the PPP loan, one thing to keep in mind is it's still available. That's the most recent update that Congress passed that bill to extend what they call a covered period, which was expired on June 30th. I think the president signed it on July 4th, and then it became effective on July 6th. It really extended the coverage period from June 30th to August 8th of this year. So that's really in response to the funding mechanisms. I think when everybody, it's only been 3.5 months since the PPP actually came into existence, and more like 3 that you could actually get a loan and an application process. But in that time span, if you think back, it's been a little chaotic. The original funding was for $349 billion for this program. That funding was chewed up in 14 days. There was an emergency bill passed a couple of days after that initial one that in April added another $310 billion to the pot. And as of July 10th, the last report that came out from the SBA, there's $132.1 billion left in the pot to be lent out. So lending has dropped down substantially from this. I think that most people and most companies, slightly over 4 million, that needed the funds have applied, received the funds. Now we're starting to get a lot of questions really on the forgiveness aspects of it. And the forgiveness pieces, you got clarified further in June with the passing of House Bill 7010. That a couple of key takeaways there, in case anybody's missing that, is it changed the usage period from 8 weeks to 24. And the other really significant piece in there was the original CARES Act mandated 75% of the money to be used for payroll. The Flexibility Act changed that to 60-40, so 60% for payroll, 40% for other items, including rent, utilities, and mortgage interest. And then they further clarified the forms for forgiveness. There's actually 2 forms now. Kaylee, you want to kick to the next slide? The forgiveness is really in 2 different fashions today. There's a loan forgiveness application that was originally released in the early part of June. It's very lengthy. It's somewhat confusing. I could probably do a half an hour just on how to complete that form accurately. and because of that, there was a pushback, and the SBA and the Treasury released what they're calling the easy loan forgiveness application. Kind of equate this to a 1040 versus a 1040 easy. It's similar to that. That's a pretty good analogy on it. The easy loan forgiveness application, if you're self-employed, you're good. You can use that form. If you're not self-employed, there are a couple of attestations you need to make in order to use the easy form. They're both listed on here. You can't have reduced your employees' salaries or wages by more than 25%. And then that's one. Then there's two and clauses there. One, that you didn't reduce the number of employees and the average paid hours during the covered period, during the time you utilize the funds. Or if you had to reduce employees, it was due to your inability to operate during the covered period at the same business activity level. So if you're a restaurant, let's say, and you were shut down entirely, there is a clause in that would allow you to continue to use that easy form. So the links will be established for both of these. There are separate instructions for both forms that I would encourage everyone to read. And the biggest piece, when we get calls on this, and I got a couple this morning, when you're filling out the applications, at the bottom of the instruction forms, there's a pretty definitive list of documentation that you need to prepare. It doesn't need to be sent back in with your application for forgiveness, but you need to prepare it and then retain it for 5 years. The SBA has come out, and the Treasury has stated they're going to audit every PPP loan over $2 million. They're going to audit some sampling of those loans under the $2 million threshold. So if they do come in for a review of your loan at some point in the future, you want to make sure that you have all that documentation ready to go. The other thing that's interesting that happened last week, was the release of all the recipients of funds over $150,000. Those companies were named. They did not release the exact number or the exact dollar that those companies received. It was more done by buckets. And then for the recipients under $150,000, they were not named, but that information is publicly available on a state-by-state basis to see where the funds were distributed. We took the macro level data and put it up into some dashboards that are actually pretty interesting. When you look at the way they play out with the way the funds were distributed amongst the different classifications. And one thing to keep in mind, there's a lot of noise. I think we're starting to see this today in the news, that mortgage companies, there's been some reports that they've taken advantage of this program, that there's too many of them and got too many funds. The way that the breakdown actually works, though, is they're 10th on this list by industry classification, and that's even lumped in with real estate, rental, and leasing. So it doesn't appear that it really took advantage of it at all. So I just be careful with that. And from the analysis that I performed on the over $150,000 loans, about 1,000 mortgage companies, independent mortgage companies and/or brokers received a PPP loan. John, you want to scroll down real quick and just look at the chart on, this is the funding. As you can see, it was kind of a mad rush at the very start in April. Then with the replenishment of funds, it was kind of a mad rush again in May, and that number's really dropped off. So we're not seeing a whole lot of activity on new PPP loans. You also remember you can only file for one loan. You can't file for one, utilize the funds, then reapply for it. So you want to kick back over to the slides? Yeah, on this slide, this is actually on part of a weekly package that the SBA releases on their website. Again, just further, and this is exact numbers. So the numbers we were looking at on the website are the minimums when we looked at the categorizations, because there's always a minimum and a maximum. But this is explicit numbers that came out for all the PPP loans, and lumped in, still the same thing, lumped in together. Real estate, rental, and leasing is pretty far down the list. Only received about 3% of the loans. Next slide. There's time for the poll question, Elijah.
Yeah, before that, actually, Elijah, real quick, David, back up on the applications. Quick question that I did that I received is so there is no, to your knowledge, there's no that $2 million threshold does not impact your ability to use the easy application.
There's nothing in the instructions that indicate there's a limit on it. Yeah, so that's maybe a poor analogy on the 1040, but
no, I think that makes sense. I think there's
nothing in there. And one thing to keep in mind for anybody that's filling out that application, you need to provide, and the instructions are pretty explicit in it. And the way that process works is you fill out the application for forgiveness. That goes to your lender. By law, the lender has up to 60 days to make a recommendation for forgiveness to the SBA. And then the SBA is going to respond in kind to that, and the lender is going to respond back to the borrower about their forgiveness on it. So if that that's the way the process goes. And I encourage everyone to reach out to the lenders as well before filing the application for forgiveness to see if they have online forms or any tools that you can utilize to do that rather than doing it all in paper form. And when you look at the breakdown of the lenders that were utilized for the PPP loans, it is the largest banks in the country lent out by far and away the majority of the funds, led by JP Morgan Chase, Wells, so a lot of the big banks. And those banks have been moving forward a lot with their technology and the ability to trying to streamline this process.
That's right. Yeah, I think I've read a lot about the fintech that they are implementing very, very hastily and quickly here. Hopefully it goes off without a hitch, but it intended to make this forgiveness process a little bit easier than it otherwise would be.
Yep.
All right, thank you, David. Let's launch our first poll question just to check in here. Again, please respond.
Yeah, and I'll keep open the poll for a minute or so. I actually have two questions for the panelists from the question panel. The first one is from Robert, and he asked, if all expense requirements are met in 10 weeks, do we still need to wait the full 24 to file? The application makes it look like so.
Yeah, that's been kind of confusing, and they haven't clarified that, but I have clients that have already filed for that. So it's really, you have the maximum is 24 weeks. If you utilize the funds in 10, 12, 13 weeks, you can go ahead and file for the forgiveness of it.
Great, and I'm gonna close out the poll here while you answer the second question, which is from Jeffrey, and he asked, do you have until 12/31/2020 to restore FTEs and salary levels, or did you have to meet those during the covered period?
I think those still have to be met during the covered period. It does not extend beyond that. So I think the intent for that was that once a borrower or company received the funds, they would utilize those funds to bring back on the staffing that they had been forced to let go. So. But there's a lot of, and if you have more specific questions about that, I'm happy to jump on a phone call with it, because there's a lot of facts and circumstances around how all that plays out, particularly around if you had an employee that you let go, they went on unemployment, you tried to call them back, they did not want to come back, that does not count against you. So there's a lot of things that come into play there when you look at it, and every case has its own kind of unique circumstances.
David, in relation to that question on the period, as long as you had applied and gotten your funds before a certain date, I think too that you could have spent, you could have left the original 8-week period.
That's correct.
You spent your funds really quickly, and in that case, you could apply for forgiveness after that 8-week period.
That's correct. And we had clients that did that because, if you think about the way the money was lent out, it was on an average of the prior 12 months. Well, if you were steadily increasing staffing for the last 12 months and you continued to, you will utilize those funds in shorter than the 8 weeks. So that's why they left that piece in there. So you can go either the 8-week line or the 24-week line.
Great. poll close, I believe. Sticking on that PPP topic, want to bring in Jennifer here. Jennifer, what kind of impacts has the PPP loans made to your world? What kind of questions or topics are coming up as clients give you a phone call?
You know, a lot of our questions right now, you know, in the initial phases, it was just generalized questions on how the program works, the criteria for meeting the program, what kind of information they needed to provide banks. But recently, most of the questions have been around accounting for the PPP loans and you know, what guidance is out there on how to actually book the forgiveness process. So I can go into that in a little bit of detail. You know, for a pocket, we had a lot of questions also on, you know, just a little bit of concern of when we took out the loans, margins were terrible. We had a ton of margin calls. We didn't have any cash. And it seems like the bulk of our clients are having record, you know, numbers. You know, a lot of them have met their yearly production goal as of June 30th, which is great news. But I think there was a little bit of concern in the beginning of we took this loan out because we really needed it. And, you know, I still think there's definitely concern for, you know, maybe the winter time or next year, what that may bring, especially as, you know, if, I shouldn't say as, I should say if forbearance starts to add up and there's liquidity constraints because of that. But I did go into the slide is specifically going around just the accounting for the PPP loans. So I could get started on that. So again, we filled out a lot of questions, and Kaylin, you may need to mute your computer. I hear a little bit of kickback.
Thank you.
So, yeah, just to reiterate, you know, we have received a lot of questions on the accounting for the PPP loans. You know, it's been a little challenging. You know, we assumed it would fall under ASC 470, which is just regular debt guidance. You know, there really isn't clear accounting guidance written that applies to a forgivable loan received by the government. It just doesn't, until this program, it just didn't exactly exist. So we were actually really pleased to see when the AICPA issued a TQA technical question and answer on the topic, but we were also a little surprised by the guidance that they provided. They basically allowed companies to account for these loans under multiple ways and multiple ways of treating the loan forgiveness. So the straightforward way, and this is typically what most of the accounting firms were kind of communicating to clients, is the, again, ASC 470, which treats the loan as regular debt. So under ASC 470, the proceeds received from the PPP loans are accounted for as a debt instrument on the balance sheet, pretty much very similar to any other debt that you're going to book on your balance sheet. There's nothing like too tricky about it or unusual. But as the loan is forgiven, you basically take that liability off your books and you're going to run that through your income statement as other income for forgiveness of debt. And how ASC 470 accounts for forgiveness, there's a little bit more criteria than the second option that the AICPA's technical question and answer gave people the option for. So it basically means when the lender of the PPP loan forgave the loan wholly or in part, and that's the point in time that would trigger the IMB to remove that loan from your balance sheet and run it through your income statement at the point of forgiveness from the lender, or if the loan was paid in full by the borrower, that would also obviously trigger the loan to be off of the balance sheet. So once that debt is forgiven by the lender, again, it's recognized on the income statement as forgiveness of debt. But within that period before forgiveness, basically you're still going to accrue interest. If you have any debt issuance costs, you're also going to amortize that over the life of the loan. So again, it's just very similar to any other debt that you would have. So the other option that kind of we thought was a little unusual, but you know, the AICPA is basically saying this is acceptable as well. They're referencing International Accounting Standards 20, and obviously that surprised us because it's an international accounting standard and not US GAAP. But that allows for borrowers to sort of treat the loan like a grant. And that doesn't necessarily mean as you get these funds, you're running it through your equity statement as a capital contribution. We've had a couple questions on that, so it's certainly not a capital contribution that you're running through equity. But what that means, treatment of the loan like a grant, it's basically saying on your balance sheet, you're going to book a deferred income liability. And so the difference between the ASC 470 and IAS 20 is that IAS 20 allows for the systematic forgiveness of the PPP loan as eligibility and loan forgiveness criteria are met and the loan forgiveness is probable. So basically, you don't necessarily need to wait for the lender to give you approval to forgive this debt, as long as you're meeting the criteria for loan forgiveness and the forgiveness is probable. And how they define probable is very similar to how you account for gain contingencies. If it's more than likely that this debt's going to be forgiven, you can systematically start running that through your income statement. So basically, this would result in that deferred income liability being slowly removed from your balance sheet as you're meeting that loan forgiveness criteria. And then you would run that through your income statement. And part of this is similar and part of this is different than if you were to account for it as debt. The part that's similar is as you meet that gain criteria and it becomes probable, you either write it off through other income as like a loan forgiveness, or you actually do a direct reduction to forgivable expenses on your income statement. So it's basically if your loan forgiveness is applying to payroll expense, you would directly reduce that payroll expense balance. And you know, that is absolutely in accordance with this technical bulletin that the AICPA issued, even though it's not really specifically written in the accounting guidance. They basically said, hey, this is an option that you could take. You know, some of our concerns with doing it that second option, meaning running it through and reducing your line items on your income statement by the forgivable portion, is just, you know, it's a little bit misleading, or potentially could be a little bit confusing or misleading to the readers of the financial statements of, you know, kind of like burying that forgiveness portion through your income statement. So if that option is chosen, it would require a footnote disclosure that basically had like a chart that explained here's the original payroll expense, the original rent, original utility, here's the amount that was reduced from the forgiveness of this PPP loan that was applied towards these expenses. So it would still be available to the reader to know, you know, how much of that forgiveness reduced these specific expenses. So that would certainly be a footnote disclosure that we would recommend putting in the financial statements. But just again, we think it's just a little bit clearer having it in a separate line item on the financial statements. And right now we're kind of waiting to see if the LEAP system or HUD provides any explanation on guidance on when we do these LEAP filings. Is there going to be a specific area that we're putting in this income from these forgiveness of loans, or, you know, how they'd like to see it from like a HUD LEAP standpoint. So that could, you know, change some things. Obviously it's not GAAP, but it would be helpful for us, I think, ahead of time to know where they would like us to put that. But if something is released on that, we will certainly get that out to everyone. And Kaylin, I think we're probably good on this slide.
All right. Thank you. Very thorough. That was very helpful. Again, sticking right there, maybe it's proper to now to turn to Jared. And Jared, if you want to touch on, what the PPP loans mean from a tax standpoint, and then kind of continue on with the other tax provisions that came out of the legislation that Congress passed in response to COVID, as many of the relief options are achieved by using the federal tax code.
Sure, thanks, Kaylin. Yeah, we've obviously spent a fair amount of time this afternoon talking about these PPP loans, and there was certainly some guidance issued both in the CARES Act and subsequent to it that talked about the tax implications related to these loans and how they would be treated from a tax perspective. So within the CARES Act itself, the main provision related to the PPP loans dealt with the forgiveness aspect, and it discussed specifically that the forgiveness of a PPP loan would not be considered cancellation of indebtedness income for tax purposes. So under normal circumstances, if you have a loan and the loan is forgiven, you are required to report the forgiven amount as cancellation of indebtedness income and pay federal and state income tax on that amount. The CARES Act basically eliminated that, and so that this income would not be treated as cancellation of indebtedness income. And so once that happened, everybody had a little party and thought this was truly free money, and we're pretty excited about the program. About a month after the CARES Act passed, Treasury and IRS issued Notice 2020-32 and indicated that they felt, or they concluded, that any expenses that were paid for or funded by a PPP loan that was subsequently forgiven would not be deductible. And so that little party that everybody had kind of after, feeling like they had free money, all of a sudden realized that it wasn't quite as free as maybe it was originally expected to be. So still a pretty good deal. You do have to pay, tax on these expenses that would have otherwise been deductible, but still a pretty good deal overall. After, some other important tax legislation that came out of the CARES Act related to some payroll tax items, and the one that everybody can benefit from is this payroll tax deferral. And so what happens is the employer portion of the Social Security tax, or 6.2%, may be deferred through December 31st of 2020. And so from the time that the CARES Act passed, which is right at the end of March, through December 31st, employers are not required to pay this employer's portion of the Social Security tax with their payroll tax deposits. And the deferred amount isn't payable. It's payable later in 2 equal installments that are due on or before December 31st of 2021 and December 31st of 2022. So ultimately, this amount will be paid. It's just simply deferred. But it's a pretty good deferral period. I mean, 50% of it you can defer for a year and a half or more, and the other 50% for 2.5 years or more. So, pretty decent deferral periods on this payroll tax component. Another, payroll tax item that came out of the CARES Act is this employee retention tax credit. And this is a refundable payroll tax credit equal to 50% of the gross pay and the employer paid health insurance costs. And it's capped at $10,000, and there's other limitations that apply as well. And anyone who receives an SBA PPP loan is not eligible for this credit. And basically what this credit is designed to do is any employees that were furloughed or had significant reductions in their work hours, but yet were still paid like a full-time employee, that's what this credit is designed to cover. So to the extent that you were paying wages to an employee that was furloughed or had a significant reduction in their work hours, then you can take 50% of that pay as a credit against your payroll taxes. Again, capped at $10,000. And there's some other nuances to this credit as well. So, you know, like anything with tax, it's often facts and circumstances based, and it's, you know, taxpayer specific. And so certainly recommend on all of these provisions that you would consult with a knowledgeable tax professional who can assist you in understanding these provisions and how they might apply to your specific fact pattern. Next slide, Kaylin. So a few other provisions that came out of the CARES Act. One was related to net operating losses. So under the Tax Cuts and Jobs Act that was passed back at the end of 2017, they eliminated the carryback potential for net operating losses. And so to the extent that a corporation or individual incurred a net operating loss in a given year, they were unable to carry that loss back to any prior years, but were entitled to carry it forward indefinitely. The CARES Act came in and provided for a 5-year carryback period of NOLs that arise in 2018, 2019, or 2020. So if you incurred an NOL in 2018, you can now carry that back 5 years or back to 2013, 2019 back to 2014, 2020 back to 2015. So this was a great provision for those that had losses but were unable to carry them back to offset income that they may have generated in these earlier years. Also related to net operating losses, there was a temporary repeal of the taxable income limitation. And what that was for NOLs that were generated starting in 2018, you were limited on the amount of taxable income that you could offset when you carry that NOL forward into a future year. So for example, if you had an NOL that you generated in 2018, you could use it to offset income that you had in 2019, but you can only offset 80% of that income. And so you were still gonna owe tax on 20% of that income. That provision did not apply to NOLs that were created prior to 2018. So if you had a 2017 NOL, you could still offset 100% of your income if that was carried forward. And so what they've done is they've repealed that for tax years beginning before 2021. So now if you have a 2018 or 19 NOL and you carry that forward to say 19 or 20, you can now offset 100% of your income rather than being limited to 80%. Another provision out of the CARES Act is the excess business loss limitation. So the Tax Cuts and Jobs Act, again of 2017, implemented a provision that limited the amount of business loss that a individual taxpayer could claim and deduct on their personal returns. And so what you were required to do was net your business income with your business losses, and to the extent you had a net business loss in that calculation, then you were limited to, if you were single, you were limited to $250,000 of that loss. If you were married, it was $500,000. The CARES Act basically removed that limitation for losses, excess business losses that arise in 2018, 19, or 20, and made the full amount deductible in those years. And again, so now if you have a business loss in excess of those amounts, and you can claim that full business loss, and that results in an NOL, now you can carry that NOL back. And so there could be the potential for some significant tax benefits under these provisions.
Jared, yeah, real quick, what's the case for potentially a loss, let's say a loss generated in 2019 and carrying it back instead of, if I'm here in 2020 and I'm making good money, know that I'm going to be have taxable income in 2020, and just say, oh, I shouldn't worry about carrying it back. I'll just carry it forward and know that I'll be able to use that loss to offset 2020 income. What's the business case for rethinking that?
Sure, yeah, it's a great question, Kaylin. There's a couple of things that come to mind. One is simply the acceleration of the cash benefits of carrying it back rather than having to wait until you file your 2020 return to realize that benefit. You can file either an NOL carryback or an amended return now and receive that cash benefit up front. The other reason, and maybe even more important reason, is the fact that most taxpayers were likely in a higher tax bracket in these earlier years. So if you're carrying this back to say 2013, 2014, 2015, 2016, one of these earlier years, when the tax rates were higher than they are now, there is an incremental and permanent benefit to carrying it back and receiving back tax dollars at say a nearly 40% tax rate than the current highest tax rate being 37%. Just to continue down the list here, the business interest expense limitation, there was an adjustment under the CARES Act to that as well. So again, going back to the TCJA, the net business interest expense of a taxpayer is limited to 30% of the adjusted taxable income. So again, if you take your net business interest income, net it with your net business interest expense, if that results in a net business interest expense amount, then you were limited on how much of that net business interest expense you could deduct to 30% of your adjusted taxable income. And under the CARES Act, they increased that to 50%. So those that had limitations in say 2018, 2019, now this provision allows you to perhaps benefit or take some additional business interest expense deduction in these years since the limitations increased. Qualified improvement property. This was actually a technical correction from the TCJA, where the language in that act designated QIP as 39-year property, and by doing that, it made it ineligible for bonus depreciation. And this was actually an issue that was supposed to be resolved in the TCJA, but the final language that came out in that bill did not address it properly. And so finally, under the CARES Act, they made the technical correction to designate qualified improvement property as 15-year property for depreciation purposes. And this correction allows QIP to qualify for bonus depreciation. QIP, for the most part, is your leasehold improvement type property. So if you're a lessee and you're making improvements to a commercial building of some kind, then those improvements now will be designated as 15-year property for depreciation purposes and qualify for bonus depreciation. So that could be a nice benefit for those that are expanding their business operations and making those kinds of improvements. So before the CARES Act, as Kalen described earlier, walking through his timeline, before the CARES Act, there was the Family First Corona Response Act, FFCRA. And in that act, it was primarily dealing with qualified sick leave and qualified family leave pay. And one of the tax provisions that came out of that act is that there was a credit that was provided for, and you could use this credit against certain payroll taxes, and it's equal to the wages paid for qualified sick leave and qualified family leave. So to the extent that you as an employer are paying qualified sick leave or qualified family leave to any of your employees under this act, there is a credit available that can help offset some of the payroll tax obligations that you would otherwise have. Finally, and somewhat unrelated to any of the recent legislation that came out, is a provision in section 165I of the Internal Revenue Code. And again, this provision predates sort of anything that's happened related to COVID-19. And this provision talks specifically about disaster losses. And basically what it says is that to the extent there is a federally declared disaster, which this pandemic was a federally declared disaster under the Stafford Act, you have the ability, to the extent that you have incurred a loss, that you can, and it's kind of narrow down or specific certain types of losses, but to the extent that you have a loss that you can attribute to the disaster, you have the ability to make an election under this Section 165I to claim that loss on a prior year return. And so to the extent that losses were incurred here in 2020, and we can directly attribute those losses to the pandemic, then we have the ability to make an election and actually claim those losses on a 2019 tax return. And so again, it's only certain types of losses. We're not talking specifically about a full net operating loss here. And it's a little gray as it relates to a pandemic, because if you look at any of the guidance out there or any of the cases that have dealt with Section 165I in the past, these cases in this guidance have really dealt mostly with disaster losses as it relates to like physical damage to property. And so, you know, most of the time when you think of a disaster, you think of a flood, of a hurricane, an earthquake, some sort of natural disaster that caused, you know, property damage of some kind. And it's pretty easy to identify the loss and determine the amount of the loss. In this case, we're talking about losses attributable to a pandemic. And so it can get a little bit more gray, but we've certainly worked with some of our clients to try and see if there's an opportunity to look at perhaps their loan portfolios or their hedging activity sort of during this time, and see if there's any potential losses embedded in those portfolios that we could, you know, pretty easily attribute to the pandemic. You know, as you all know, as soon as the you know, pandemic hit and the disaster was declared by the president, pricing on loans, you know, dropped substantially. And so embedded in that, and embedded in some of the hedging activity that occurred during this time, there could be potentially some losses. And you know, if that number is sizable enough, it might make sense to take advantage of this election and report that on a 2019 return. There's a couple of benefits to reporting on the 2019 return. One is obviously you get to reduce the income that you report on that year, and therefore reduce the amount of tax that is due on your 2019 tax return. The other benefit is that from a safe harbor perspective, it can also help reduce the quarterly estimated tax payments that are due for 2020, because from a, you know, if you're using the safe harbor rules, your 2020 estimates are based on your 2019 taxes. And so if you're able to take this loss back and significantly reduce your taxable income in 2019, that can also help reduce the amount of taxes that you might have to pay in quarterly estimates, at least on your 2020 tax year. And if your 2020 tax year is substantially better than your 2019, that allows you to kind of defer a bulk or a significant portion of those taxes until you have to file your returns either next March or April. So something to you know, kind of think about. We've been advising some of our clients on this provision, and happy to kind of help look at your specific fact pattern and see if there's maybe an opportunity to take advantage of this provision.
Yeah,
and with that, Caitlin, I think that covers the tax provisions.
Thank you, Jared. Yes, clearly understanding all of the tax impacts is really where you can start to look to uncover a lot of this relief and make it available to your company if these if certain facts apply. But in the interest of time, I'm going to move forward, and I think we're going to launch another poll question, Eliza.
Great, I'll give you guys about 30 seconds to fill that out. And we also have a question from Michael. He asked this, I think, while Jennifer was talking. We are bi-monthly payroll. We received our PPE, I think he means PPP loan, on April 9th. Would the payroll on April 15th, 2020 qualify? I read that it's paid or incurred. I wasn't sure if I need to allocate payroll on days or use the full payroll amount.
This might actually be more for David Rice, but I imagine you would allocate it.
Yeah, it can be allocated. So it's either as paid or as accrued. So you could utilize the PPP for the entirety of that first pay period. They gave some flexibility in how that could be, if that was part of the Flexibility Act that came out as well.
Great. I also sent him David's email to reach out to, and I think we're all just about voted. So I'll give you about 10 more seconds to get your votes in. Those last 2 people that voted in the first one but haven't voted yet, go ahead and get those in. I'm going to close it in a second.
Yeah, I'll add there, Eliza, that thank you for sending David's contact info. On the slide deck we will distribute, I'll definitely add a contact slide to the end of this deck for all of the panelists here so that you can reach out with any further questions. All right. Jennifer, I think you're probably best suited to potentially talk about forbearance. I know it's probably the hottest topic on the minds of mortgage lenders out there, and something that came out of the CARES Act. So while not relief specifically, offered to their companies and their company operations, it's something that they do have to pass through as a relief option to their borrowers. Can you talk about the impact a little bit and the conversations again that you've been having with clients around forbearance?
Yeah, I'd be really curious as to what the poll results showed on that one, like how big of an impact forbearance had on the audience. So, this one's a bit of a challenge as well, just because it's so, I wouldn't say the actual forbearance itself is new, but just the impact of it is kind of in the startup phase. In having conversations with clients, I think the most commonly asked questions are, should I be increasing my loan loss reserve for forbearance? That's been one of them. Some of the feedback from a lot of our clients has been, even though a borrower is in forbearance, a lot of them are still making their monthly payments. And then another area of feedback I've gotten has been, our numbers really aren't that high yet, but we don't know what, the fall or early next year is going to bring. Based on how the program is set up, we don't foresee at this point in time there being a significant need for changes within that loan loss reserve due to the loan modifications of the loans that are in forbearance. ASC 310-40 receivables, it basically says, FASB is basically saying that these loan modifications should be encouraged and not necessarily accounting for them as troubled debt restructure treatment. The servicing fee income on these loans and forbearance interest should continue to accrue in deferment plans that may not necessarily be the case. And then for P&I, T&I servicing advanced liquidity issues, Fannie and Freddie both have the 4-month advance obligation limit on loans and forbearance. And then Jenny May, you have basically receivable accounting related to the recoverable advances and any potential allowances on unrecoverable amounts, which hopefully is pretty nominal or a small dollar amount. So again, as this progresses, we'll certainly put more information out there. I'm really curious to see, end of year, what happens. Hopefully this doesn't happen, but as more and more of these forbearance percentages go up, if that is the case, how the valuation companies are coming up with value for the servicing rights surrounding them, and also just the liquidity impact that it could potentially have on our client base. Right now, it hasn't seemed to have much of an impact on our clients. I've heard maybe 3 to 3.5% of people's portfolio may have had loans and forbearance, but I have also heard a lot of clients that I've spoken to over the past month, you know, being really motivated to save cash to make sure that their liquidity is in a good position. So if they have to make a significant amount of advances, they're in a good position to do so. But as more information comes out on this, we'll certainly post blogs and send emails out to everyone.
Yeah, I think that's the key point, Jennifer. Thank you for mentioning that. This specific topic, we do have a blog post up if you want to go reference our website. But certainly, I think we'll know a lot more in the next month to 2 months as the kind of forbearance periods are lapsing, and absent any extension from Washington of these mandatory forbearance. I think a lot will be known here in a month or 2 months as borrowers work through, loss mitigation plans or other ways to reconcile with the forbearance they had been placed in. So more to come for sure. Let's continue on forward. Got about we just want to respect everybody's time. Got about 4 minutes, and we'll plow through these next couple and launch the last poll question. David.
Yep, yeah, so I'll run through this one pretty quick. So for everybody that's that services the FHA loans, hopefully you saw this announcement. Came out as FHA Info Bulletin 20-44 on June the 22nd. 3 big things that it talks about is the waiver of QC requirements for early pay defaults for the months that would normally be selected in your QC reviews for May, June, and July. That's the extent of the temporary waivers, May, June, and July. Likewise, there's a removal of 10% field testing for appraisals in that same time period, May, June, and July. And the other interesting thing that they threw in there, it wasn't really a change, it was just a little bit of a clarification on their part, was on the compare ratios. They did state they're unable to remove loans in default or claim status from Neighborhood Watch, which includes loans in forbearance. And since they use that compare ratio as one of the guidelines for maintaining your Richey May licensing, they did state that FHA will consider the impact of COVID-19 as a relevant mitigating factor in a mortgagee's compare ratio if it is above the designated threshold. So while they're not taking it away, so we're going to see the compare ratios go up because I've seen numbers as high as 11.5%, 12% of FHA loans are in some form of forbearance today. National average is in the mid 8s, but the Richey May portfolio is adversely selected for that. So you'll see those compare ratios go up, but they did indicate they're going to give some relief on that, just looking at it from a COVID perspective. That's my 2-minute version, Kaylin.
Awesome. Thank you. I appreciate that. Again, this is another area. I think we have a full blog post with more details and certainly a bunch of links to other resources. So can't say it enough. Please visit our website. You'll get a lot more there and be able to target exactly what topic you're interested in. Let me move. I'll just mention these really quick. We promised as a part of the description of this webinar that we'll review what has already been in place, and for good reason, we spent the good chunk of the hour on things that are already passed and available and should be utilized and focused on and understood. But this, in the last minute here, these are some of the things that could work their way through to offer additional relief if needed, and specifically would impact the mortgage industry. The Neighborhood Homes Investment Act has actually been taken up by a bipartisan group of senators. It's actually a bill that was written last summer that has been that was written in the House, not passed in the House, but brought to the floor of the House, and is now being kind of rehashed, as there wasn't much traction back then. Anyways, just the main principle of this act, it's been referred to, you could see there, as the single family version of the affordable housing tax credit. It offers a tax credit in areas where rehab is done on a neighborhood of single family homes. and their areas designated that would be designated all over the country there. And then just on an MBA webinar just yesterday, I believe, just passing along the likelihood or their stance on some of the big provision that was passed by the House, namely the HEROES Act. It was up in the timeline. This was another stimulus package that passed in the House. No one really believes that it has a chance in the Senate as currently constituted, but there technically hasn't been a vote on it yet. I'll just draw your attention to the poll that launched, and I'll keep speaking. Hopefully you can hear me, but make sure you get that poll question answered for the last bit of the CPE. Anyways, the main focus right now, it wasn't necessarily dead on arrival. The Senate never took a vote, but they're at least talking about it in the press. If you haven't been paying attention, they are at least examining parts of the HEROES Act that they will consider and potentially will pass if the economy does slow again. So similar stimulus programs that came out in the CARES Act, but most of them right now are focused on individual kind of taxpayers or the average U.S. citizen, and in energizing the economy through stimulus packages to them. With that, I want to thank everyone again, especially the panelists and participants here. We really appreciate your time. Have hopefully offered some value to you, and like we said, we will follow up with CPE certificates and the materials that we used today. Thank you for your time, and we will see you again.